Hello everyone. My name is Majesty. I'm an Atlanta-based real estate developer with 13 million in assets under management and another 50 million in the pipeline. I build and rehab apartment buildings, so stick around for some real estate tips and information. I'm doing a 100 question series over 100 posts, answering common questions I get from people on all spectrums of the investing world, as far as questions that I get, common questions, and I'm answering them through the video in hopes to provide value to more people. Today's question is, how do I calculate the ROI on an investment property, on a real estate investment? And real quickly, let me define ROI or explain ROI. It stands for return on investment. Everybody that invests typically is expecting some type of return. They all have different, ways that they calculate the returns that they would like to get back. Some people are higher, some's lower, but they're gonna want something back for investing. And that's essentially what an ROI is. It's not specific to real estate. It measures the profitability of an investment, essentially, and it helps investors compare different investments, even across asset classes like stocks to crypto to real estate, to see where they may want to put their money. And it also helps to assess the performance of these investments to see how they're performing over time, to see if maybe you should stay in it or maybe add to your position or pull out of it. But essentially, it just helps to, kind of calculate and stay on top of those things. And it also lets you know if a project is financially viable, like if it makes sense to get involved with it. If the ROI doesn't meet your requirements, then most likely you wouldn't want to move forward. So I'll just kind of go through a quick rundown of the ROI formula, and we'll do some mental math together. I'll keep it simple, I promise. Just to kind of highlight how to calculate the ROI. It's very simple. So the ROI equals your net profit divided by your total investment cost. And typically in real estate, the total investment costs are called like total project cost, all-in cost. There's different names for it, but basically all the money that you put into the project to get it to where it is positioned to start bringing in money. Whether that's a flip, that means like completing your flip, all the way, or whether it's a rehab of a multifamily building, to the point where you're starting to be able to bring people in and lease it out. Same thing with like a new construction. It's the total project cost to get it up to the point of earning money. And your net profit equals your total income minus your expenses. So however much money you're bringing in minus the expenses. Simple, I promise. Total income can include rental income and property appreciation. And also your total expenses includes everything from your purchase price, repair cost, operating expenses, taxes, insurance, etc. Whatever the costs are to operate the property, and what's left over is your net profit. So let's do an example calculation. So we'll do a simple project. We'll just say we're doing a quick flip. We're buying a house for $92,500. We have about $2,500 in closing costs. That brings us to 95. And then we have 5,000 in renovation cost. Not sure where you do that in this market, but that's $100,000 all in total investment. You invest into this home, you buy it for 92.5, 2,500 in legal fees, and you put 5,000 into it, and now you're able to rent it out. Okay, so let's assume that you're able to rent it out for $20,000 a year, and that's yearly, not monthly. So you get 20,000 a year, and then it costs you 10,000 a year to operate it. Let's just say management, all of that, taxes is 10,000 a year. So 20,000 is what comes in, 10,000 goes out. That leaves you with $10,000 in net profit. And remember, we spent $100,000 total on the project altogether. So how you would calculate the ROI is now you would divide that $10,000 of net profit that you kept over the year by the $100,000 that you put into the project. And for this one, we're assuming it's all cash. So you brought in 10,000 and you put out 100,000, or you put out 100,000, brought in 10,000, however you want to look at it. So that leaves you with a 10% or 0.10 percent when you do that calculation, which is 10%. So your ROI on that particular investment is 10%, which can be seen as pretty good. It depends on what your goals are. It just depends on a lot of different things. We typically look for something a little higher than that for ourselves, but it really just depends on what your goals are. But that is how you calculate the ROI. So it's not a difficult calculation. You need the inputs to be able to calculate that. So it does take a little bit of research or just information gathering, but ultimately that's how you do it. And there's some alternative ROI calculations as well, such as you'll hear cash on cash return. Now in our previous example, it was all cash. But let's assume if we use a mortgage, then, or if we use a loan, then now my down payment is my actual investment. Even though maybe I paid $100,000 total for everything, I only put 20% down. Let's just say 20,000. So now I'm not calculating it anymore off of the 100,000 that I put in. I'm focused on my 20,000 of cash that came out of my pocket that I had to put in. And that's another metric. That's where you hear cash on cash return, which measures annual return on actual cash invested. And so you basically do that by dividing the net cash flow by the actual cash invested. So that would be, in the same example, would be $10,000 is the net income or net profit divided by, I only put in 20,000. So that changes your ROI. Now my ROI is 50% because I made 10,000 off of 20,000, even though the total project cost was 100,000. So that kind of speaks to the power of leverage. Using cash, I got a 10% return. Using a loan, I got a 50% return. So, it don't get me wrong, it goes both ways. So it can be, it can go wrong as far as, your losses are bigger as well. So you want to be careful there. But another calculation is also ROI with appreciation. And this is similar to the first example, but now we're going to factor in the amount of value that the property has increased. Maybe the property has gone from being worth 100,000 to 150,000. So you actually build that into your net profit. You build that on the profit side. So it's net profit, that 10,000. Now it's plus that 50,000 because it's risen in value from 100 to 150. That's 50. So that is $60,000 divided by the 100, which now gets you to a 60% ROI. So you can kind of see how things change depending on what inputs you put, what metrics you use, and everything like that. But ultimately, you want to make sure your ROI is always above zero. Otherwise, you're losing money. Most people don't want to do that unless there's some tax reason behind that, and that's very complicated. So try to keep it above, at least above inflation. Otherwise, there's no point. Another thing to consider, or some more things to consider, is the time frame. So in our example, I didn't really include a time frame. If it took me 10 years to do that, then I wasted my time. If it took me 10 days, then yeah, I would want to do that again and again. So time frame is very important. And there's other metrics that include time frame, like IRR, internal rate of return, and we won't go into that right now, but you do want to consider that, because just seeing 10% return or 50% return, it's like, over what period of time? Because I don't necessarily want to take 10 years to make $10,000 or even 60. It's not just it doesn't move the needle. It doesn't help much. Also, market conditions are important. Like I was saying, the market is pretty bad right now. Like today, the market fluctuates, so it's, it is what it is. but market conditions can affect their ROI. Leverage as well. It can affect your returns heavily. That's why, everybody all the way up to BlackRock and Vanguard and, those big firms still take out debt to do their projects, because it just makes sense, depending on, what you're doing. But typically it's going to make the most sense to use debt. If you're trying to boost your returns, you're going to get more returns. Just like in that example I gave you, you'll be able to use more money. I mean, I was able to use $20,000 on the same project that would have cost me $100,000 cash. So I mean, technically I could do 5 of those projects now, and I'd be very leveraged, but it's possible. And now I have 5 projects going instead of 1 with the same $100,000. So you want to consider that. Also, there's tax implications in regards to capital gains, and also depreciation. And this depends on how long you hold the investment for. So that's a big consideration in terms of how your returns will kind of shake out. But anyway, like, share, subscribe. Thank you guys for all the comments and questions. I appreciate the interaction, and thank you for watching, and I'll catch you on the next video.